Dividend investors, bonjour, this is Mike Yo, founder of Dividend Stocks and passionate investor. Today, I want to tell you how I ended up selling my shares of Apple. But first, a story. Beginning of this week, and man, it was a crazy week on the market, right? So beginning of this week, my best friend called me and he's like, Mike, I can't believe how much money I made with Facebook so far. A few years ago, when Facebook launched its IPO, he bought shares around 30 bucks or something and then let it slide, right? Just kept them, no matter what happened, going up, going down. And then you look at Facebook today and it's up like over 200 bucks, right? So it's an amazing return. And now he's telling me, he's like, Mike, I have a problem. I have a really big problem. Facebook is like 10% of my total portfolio. And it goes up and down. So like one day it will be 12% and the other day will be 8%. And then the portfolio value will fluctuate just as much. And then I started thinking, wow, that's great. I should have bought Facebook. And then I give some more thoughts and realized I do have a superior holding like this in my portfolio. And that superior holding is Apple. I bought Apple back in 2014 before they split. And everybody will tell me, yeah, well, Mike, everybody knows about Apple. Why are you talking about it? It's a slam dunk, obvious trade, right? Well, back in 2014, it wasn't as slam dunk. Actually, a lot of investors were saying, do you remember what happened to BlackBerry? What Apple did to BlackBerry, basically? They just invented a better phone and killed the BlackBerry. That's what they did, right? And the story back in 2013 and 14 was that Samsung was doing exactly the same thing that Apple did a couple of years ago to BlackBerry. So now the shares are going down. Apple is being called a one-trick pony, and everybody's saying, you know what, iPhone, not that great, pricey, ain't gonna survive. New competitors are coming in, and Samsung is gonna take over the world. And I decided to buy Apple, and I'll tell you why. Not because of the iPhone, not because I was a contrarian, but because Apple was, even at that time, building a perfect ecosystem of products. Like pretty much everything that Apple's build or create talks to all the other devices. And I thought, you know what? The iPhone is just the beginning of something. The iPhone will be the anchor, and then you'll have all those other products that will jump back right to it and connect those people. And not to mention that Apple has one thing that a lot of companies dream of. They have raving fans. They have like fans all over the world. They are just all about their products all the time. So anyway, so I bought shares back in 2014. So you can expect, I bought them in my RRSP. So it's a retirement account. I'm Canadian. So on top of having shares of Apple surging over the past 5 years, I also enjoyed some good currency exchange as well. So basically, I ran the calculation this week and I realized that Apple is at 14.7%. So basically 15% of my portfolio is invested in Apple. And which is a good thing in a sense, because Apple is a great company. It has been built to this pandemic, but at the same time, 15% is huge for any kind of company. So I thought, well, I love Apple and I want to keep up some of my shares, but I will have to sell some of them right now. This is what I decided to do. So basically I sold almost 5% of my shares, did a 300% return on those, which is pretty cool, right? And I still have a good part of my portfolio still in Apple, but now I'm just running on profit, which is a good thing. And with that proceed, I decided to buy two companies. First one is OpenText. I already have OpenText in my portfolio. It's a great business, but I'll tell you what is most amazing about it. It's a tech stock. They are offering software to help companies managing their data. So we're talking about employees, sales, customer relationships. So basically everything that the company has, they're managing it through software provided by OpenText. OpenText has over 100,000 clients and they run on subscription-based model. Can you imagine that? Like great diversification, recurring revenue, and a technology that is built for this crisis. So I bought more shares of OpenText. And then the second play I did was to buy more share of Amazon. And it's kind of funny because Amazon, a lot of people are saying, oh, the market could crash, there's a virus, second wave. And we saw that on Thursday, the market went down almost 5%. Crazy thing. And when that happened, a lot of investors are saying, oh, I'm buying gold because gold is safe. Gold is my safe haven. Like, I trust gold, everybody trusts gold. And then you see that gold going up. And it's pretty much the same story all the time. And I'm telling you something. The first people that are getting into gold are making a lot of money. But what happens, and you can look back at 2010, 2011, when gold was skyrocketing, and then what happened? Well, they realized that there were better options on the stock market. They sold their gold and then they left. So people that are late to the party to gold, they lose money, or they're stuck with their ounces of gold for like years and years and years, and all they will be able to do in terms of returns is pretty much inflation, and sometimes even less than that. So instead, I decided to protect my money by buying Amazon. And here's my thinking. And I am a dividend guy. I am 100% invested. And now 90% of my, more than 90%, like 94, 95% of my portfolio is in dividend growth stocks. But I do have now a 6% position in Amazon. It was 3, I doubled it up. Why? Because Amazon is built for this pandemic. No matter what happened, call it a recession, a depression, a stagflation, hyperinflation, all the inflations team together, there's one thing that's going to happen. People will need goods. And if they're scared to go outside, they will order it online. And where will they go? They will go to Amazon. And this is what's happening right now already. I'm not foreseeing the future. It's already happening. So instead of protecting my money with gold or with cash and wait for that incredible opportunity on the stock market where everything is going to drop, I decided to put more money into tech stocks, looking at companies generating cash flow, generating a great future, and being built for this pandemic. This is how I protect my portfolio while being 100% invested. I want to invite you next week to my next webinar on Thursday, July the 18th. Free webinar, free replay if you cannot make it live. I'll discuss my entire buy process, how I go from selling Apple to buying OpenText, step-by-step process. And the point is, my methodology is not better than yours. It's not better than anybody else. And I'm not going to make you the best Warren Buffett ever, right? But what I'm going to do with that, and what this buying methodology does for me, is it helps me to invest with conviction. And when you invest with conviction, it means you don't have doubts. You don't have dilemmas. You're not stuck in analysis by paralysis. You're just moving forward. You're sticking to your plan. And you know what? This strategy works all the time. So next week, link description, click on the button to register, 100% free. I'm giving tons of things, and I'm always sticking around to answer all your questions on top of that. So I hope it's going to be a meeting, and I hope that you're going to have a great weekend. And until the next video, stay invested.